Hey, hello everybody and welcome. Welcome to today's training. I'm really excited to see you all here. I want to make this consistent every Sunday, somewhere between 11 a.m. and 2 p.m. West Coast time. I will try to give you as much notice as I can. 2 p.m. seems to be really good for me because Sunday is the day that I take care of a lot of personal stuff, like I washed the dog this morning, things like that. So for those of you that go to church in the morning, take care of some errands, I hope being a little bit extra in the day, or a little bit later in the day, I should say, is going to work out well. So we're going to play around with this. We're going to test. For those of you that answered the survey, I just want to say I appreciate you. I would like to do 2 sessions per week, and it seems like Sunday's a good day for a lot of people since a lot of you folks are still working during the week. And it seems like Wednesday or Thursday are going to be good days to do a second, maybe a Q&A session, some sort of training, things like that. Hey, Craig, how you doing? Welcome. Thanks for coming to the training. So today, there's a few things I want to talk about. I guess a couple announcements. One thing, like I said, twice a week, I would love to have a training. Number 2 is please post your questions in the group. I know they're on an approval status right now. That's just because I want to make sure I see everything. Facebook's algorithm has been doing some very weird things in the last few months, ever since some of the privacy things that have been coming up. They're increasing their level of privacy, which is good, but I want to make sure I see every question. So most likely everything will be approved unless it's something that's just weird or just doesn't apply. But then we'll have a chance to have everybody answer on that. And like I said, Wednesday or Thursday will probably be the second day on top of Sunday that we'll be doing a live training of some sort. So I'd love to see you guys. Like to let you see my face. For those of you that don't know me, we have 100 new members this week, which is wonderful. My name is Jason J. Hamilton. I am the founder of Keep It Simple Financial Planning, located here in Orange County. We are a registered investment advisor, fee-only financial planning, so we don't sell products, no stuff like that, only advice, okay? So, if you need anything, let us know. We work with clients nationwide. We're now in 8 states, so we can help you out. But we provide these trainings, or I should say I provide these trainings so that you can continue to build your knowledge on retirement planning topics. And really, these trainings are guided by you. So as I post surveys, on what you want to learn about, definitely make your opinions known. Social Security by far was number 1 when it came to what you want to learn more about. I can totally understand why. There are 10,000 ways to claim Social Security, really 10,000. So that it's absolutely crazy. Article just came out today from Social Security Administration that thousands of retirees are not being notified of the benefits of things like delaying Social Security and how much additional income that will really mean for them long-term, inflation adjusted, which is very, very hard to find guaranteed inflation adjusted income with any sort of annuity. It almost doesn't exist, or pensions even. But Social Security is one of the few things left. So I'm a big fan of delaying to at least full retirement age if you can. If you can do later, that's better, okay? It can be better for long term. As long as you have the assets to cover yourself, you'll see my posting this group a lot. Delay, do not take it 62. I know some folks here disagree with me because they've had family members that have passed away early and didn't get their Social Security. But I'm basing my data on hundreds of thousands of people that are living much past 70, with the average age being somewhere between 86 and 88. That's kind of the average age people are living if you've already made it to 65. Lord knows things can happen, okay? But what if you were to live to 97 or 98? For those of you that don't know, I did post in there in the group, but my grandfather did pass away at 97 years old just last week. So really sad to hear. But 97, he lived a great life. That's a very, very long life. That's more than, a lot of us can ask for. But he did have to have care for quite a few years. So when we talk about long-term care insurance and really making sure your income and your assets will last, Social Security is one of the foundational aspects of you really making sure that you don't run out of money. Getting the highest floor you can, as they say, or the lowest amount of income that you would have from Social Security is a wonderful strategy. So today, we are going to talk about, the taxation of Social Security benefits and how to mitigate taxes, okay? I don't usually try to use fancy words like that. I usually just say lower taxes or whatever it may be, but mitigate, I think, is a really important word for this subject, okay? Because the definition of mitigate, there's a few definitions I pulled out of the dictionary. One is to cause to become less harsh, okay? So you can't always avoid taxes, but can we cause them to become less harsh? Absolutely we can, by using good strategies like I'm going to teach you today. To lessen in force or intensity, so that essentially means lower. We want to lessen in force or intensity any taxes that you're paying on in retirement in general, but obviously on Social Security. That's what we're talking about today. Or to make something bad less severe, okay? So some folks see taxes as bad. I think they're good and bad, depends on how you're looking at it. They're bad if you're in retirement because we want to lower them as much as possible. I think they're good when you're in your earning years, because if you're paying taxes, that means you're earning a good amount of money. In all honesty, people think our taxes are high, but they're really not that high comparative to other places here in the United States. So if you're paying taxes, that means you're earning a good income. So I see that as a good thing in a way, but I still always want to lower them, right? So it's two double-edged sword there. So today, I'm going to make sure everybody can hear me. If you want to give me a thumbs up or just say yes in the comments, please make sure that you can hear me. Everything's coming clear. It looks like it is. I have my second station set up, but if anything goes on, please put a comment in there and I'll try to fix it, okay? So let's get into today's topic, okay? I'm really excited to share this with you. Let's see, let me get my little screen up here so you can still see my face. Let me double check that. You know what, let me do this here. Let's try this and let's get me active. Okay. Okay, looks good. I think we can all see that. Hopefully you can see my ugly mug in the bottom corner there. So you can see my face as we're talking here. Jim comment, mitigate and bifurcate are two of a tax accountant's favorite words. Yes, absolutely. Totally agree with that. Taxes are just one part of what I do. Specialists in taxes are wonderful. I love you guys. Keeping up on all the tax laws is just crazy. I know what I need to know. And then I partner a specialist for anything that's weird. So hi, Leanne. Welcome to the training today. Thanks for coming. Appreciate it. So today we are going to talk about taxation of Social Security benefits, okay? So heads up, the last training we did was definitely a little more general. Today I'm going to get a bit technical, okay? You know, anytime I get into technical things, I worry that I'm going to overwhelm people because this is what I'm supposed to do essentially in the background, but I do want to educate you. So I tried to give a couple examples today that are pretty straightforward. But if you have any questions, you know, always leave a comment and I will be happy to jump in later and do my best to address them, okay? So today we're talking about planning strategies to mitigate the impact of the taxation of Social Security benefits. If you have heard of the word provisional income, we're going to talk about that. If you're worried about paying taxes on your Social Security, I'm going to give you a list of strategies today, okay? So please stay to the end. There's a really, really good list of strategies that are in there that will really help you out. I think it's going to be very, very positive training for you today. So, Social Security benefits are subject to taxation only if the worker's total provisional income exceeds certain thresholds. So, I wonder if anybody here has heard of the term provisional income. I know Brian had made a comment about how to lower provisional income. I'm going to tag you on this later, Brian, to make sure you watch this because I have some good strategies for you. But has anybody heard of provisional income? If you have, please just type Y in the comments. If not, that's okay. So let's talk about provisional income, okay? Let me tell you like how it's calculated. So provisional income is what you have to pay taxes on essentially. So how it's calculated is you would take your adjusted gross income, AGI, okay? AGI is what you pay taxes on normally, but that excludes Social Security, okay? You're gonna take adjusted gross income. You're gonna add any non-taxable interest. So things like muni bonds, okay? Muni bonds are a non-taxable interest. Plus 50% of your Social Security benefits, that equals your provisional income, okay? So AGI plus non-taxable interest like muni bonds plus 50% of Social Security benefits equal your provisional income. Okay, so depending on your provisional income, you could pay tax on up to 50%, or even 85%, I meant to say your, not her, Social Security benefits, okay? This is men or women. This does not apply to a certain sex of any sort, but up to 50 or even 85% of your Social Security benefits. So benefits are tax-free if the provisional income is less than $25,000 for those filing as single or head of household, or $32,000 for those who file a joint return, okay? So you get up to that much tax-free. if provisional income is between $25,000 and $34,000 on a single person's return, or $32,000 to $44,000 on a joint return, for every dollar of income between the lower and the upper bases, 50 cents of Social Security benefits become taxable up to 50% of the total benefit. I know that's a lot of words there, but let me just repeat that to make sure that sinks in a little bit because this is really important. So if your provisional income, which is from the formula I just showed you before, is between $25,000 and $34,000 on a single return, a single person's return, or $32,000 to $44,000 on a joint return, for every dollar of income between the lower and upper bases, 50 cents of Social Security benefits become taxable up to 50% of the total benefit, okay? So, and one more thing on this I should say. So finally, if provisional income exceeds $34,000 for singles or $44,000 for married couples, then for every dollar of income above these thresholds, 85 cents of Social Security benefits become taxable up to a total taxable income of 85% of the benefits. Okay, so regardless of the level of an individual's provisional income, this is currently 15% of his or her benefit will always be tax-free. For any of you that have been violently searching online about Social Security, how long it's going to last, and all the the things that may be coming up, 2034, we're expected to be totally fine. After that, we're expected to have some issues with payouts of Social Security, and they expect benefits may be reduced. I actually think they may consider doing something like this, taxing the full benefit, but right now it's currently 15%. Will always, it says always be tax-free, but at any time things can change, okay? But that might be one way that they cover the payouts of Social Security. It's to borrow from Peter to pay Paul, as they say. So an important thing to note here, okay? These thresholds are not indexed for inflation. So what does that mean? More Social Security benefits are taxed each year due to cost of living adjustments. So if your cost of living, your adjustments go up and you're going to get higher Social Security, more and more of the benefit could be taxed. Also, if you're taking out higher amounts from some sort of tax deferred account where you would pay taxes on, like an IRA or 401k, potentially, more and more of your benefit could be taxed each year. Okay, so really paying attention to this and planning for it is really, really important. It can save you thousands of dollars if you do it right. So most states currently don't tax Social Security benefits, but there are 13 that do. And these are all varying levels, so it's not really appropriate, I don't think, to get into a conversation about it here. But if you're in any of these states, Colorado, Connecticut, Kansas, Minnesota, Missouri, Montana, Nebraska, New Mexico, North Dakota, Rhode Island, Utah, Vermont, or West Virginia, these states all have some sort of tax on Social Security benefits. Most of them are actually pretty high on the income side for you to actually have to pay anything on the state level, but you need to be aware, right? If you're retiring in any of these states, you want to make sure you're planning for this, because a couple $1,000s a year can make a difference. That could be your extra cruise that you take in retirement, So I want you to be aware of these states if you are in them. Let's make sure we do some research on this. If you need help, again, reach out as always. Okay, so I'm going to give you an example. Okay, we're going to get a little bit on the technical side. Okay, a little bit on the technical side, so bear with me. But I want to give you some actual examples that you can compare to your situation when it comes to the taxation of Social Security benefits and provisional income. Okay, so let's talk about John and Rita. So John and Rita, here's their situation. They have an AGI, an adjusted gross income, of $28,000. Okay. They also have a municipal bond interest of $1,000 of income from there. And their Social Security benefit is $22,000. So a little bit kind of medium, low side on the benefit, about average, I would say. And, not much else, other sources of income. But these numbers are important. Okay, so how we're going to figure this out is we're going to take the $28,000 AGI. We're going to add the $1,000 municipal bond interest, because remember, any non-taxable interest is included in this formula, okay? And then we're going to add $11,000 to that, because that's 50% of their Social Security benefit, okay? Let me go back one screen just so you can see this one more time. They have the $28,000 AGI, $1,000 of municipal bond interest, and their total Social Security benefit is $22,000, but we're only going to include 50% of that, okay? Okay, so when we have those numbers, 28,000 plus 1,000 plus 11,000, that equals $40,000. Okay, hopefully I did that right. It looks like I did. So their provisional income is $8,000 above the $32,000 low range of the threshold, the low end of the threshold range. Okay, remember I said $32,000 is the low end, so we're $8,000 above that. Okay. And as I said before, up to 50% of the benefits are taxable between $32,000 and $44,000 for those married filing jointly. So 50% of the amount that these folks have above the $32,000 is 50% of $8,000 is $4,000. So that means $4,000 of their benefit amount will be taxable. Okay. So I know it seems a little bit complicated, but it's not a huge amount, but it does make a difference. You know, it does make a difference in your actually net income, which is what you have to live off of in retirement. So it's really important. So in this case, we're going to take 50% of $8,000, which is what they're over the $32,000 threshold. And that means 50% of $8,000 is $4,000. So that amount will be taxable. Okay, so that was a pretty simple, straightforward example. We're going to get, I hesitated doing this example, but it's a little bit more technical and it probably applies to more people. So we're going to get into it, but this is Peter and Faye, so stay with me here. Again, if you have any questions, drop them in the comments, either now or after when you watch this training later, and I will do my best to answer them for you, okay? So let's talk about Peter and Faye. So Peter and Faye have a higher AGI of $60,000, okay? They have no municipal bond interest, so we don't have to worry about that. But their Social Security benefit is $42,000 a year, okay? So we're going to take their $60,000 AGI plus 1/2 of their Social Security benefit, which is $21,000, and that gives us $81,000 of provisional income, okay? So in the $32,000 to $44,000 range, since they are, married filing jointly as far as their taxes are concerned, between that range, 50% of the benefit amount is taxable. So since they're in that range, that range is $12,000. 50% of that amount is of $12,000 is $6,000. So in that range, they're going to have 50% of their of that $12,000 become taxable. So they have $6,000 is taxable at 50%. And they are $37,000 above the $44,000, which is the top of the 50% threshold range. So now they've entered into that 85% taxable range. So 85% of $37,000 is $31,450, okay? So they have $6,000 plus $31,450 equals $37,450. That's potentially taxable, okay? But we must make sure that this amount is no more than 85% of the total benefit, okay? So I know I'm probably gonna lose a couple of you folks here, but this is really important. So if you need to rewatch this, it's gonna be posted in here. You can go back and go through this sort of step by step, but this point is really, really important. We wanna make sure that this amount is no more than 85% of the total benefit amount. So where that leaves us is we would take the total benefit amount here, which is $42,000. Remember, their Social Security total benefit was $42,000. We're going to multiply that by 0.85, which will give us 85%, and that number is $35,700. So that's actually the maximum amount that can be taxable, and it is actually lower than the $37,450 that we calculated earlier. So only $35,700 is the taxable amount for Peter and Faye, okay? So I really hope this makes sense. You may have to watch it a couple times, but this is how these calculations work, okay? Again, if you need help with this, let me know. But they're not gonna have to pay taxes on the whole amount, but they will have to pay taxes on the majority. But hey, you know, anything we can save on taxes is always a good thing, so we'll take it. Hello, Miriam. Welcome here. Thank you for joining. Thanks for saying hello. So here's something that I found interesting. 70% of Social Security recipients pay no tax on Social Security. None of, about 70%. About 15% are taxed on 85% of their benefit due to their high incomes, okay? So 70% pay none, 15% pay 85%. Okay, what about the people in the middle? The final 15% are the middle income range, and the tax on the benefits is starting to phase in. So I find a lot of folks are in this range, to be honest with you, and this is where I think getting with a really knowledgeable financial planner would really be beneficial for you because it can save you a lot of money long term. But most folks, we'll talk about the range that they're typically in, but recipients in this range, in this phase-in range, are subject to what is known as the tax torpedo. Okay, so you may have heard this before. Some of you have, some of you probably haven't, but this tax torpedo is kind of a mess because a lot of folks with some assets are actually in this range, but they may not even know it or be planning for it as they're going into retirement. But it's really important. Okay, so this is a popular term in the planning world and the Social Security world, but I'll try to show you some ways how to avoid this. So most studies have shown that those with wealth between $250,000 and $600,000 are most susceptible to this tax torpedo. Okay, that's sort of the range. I find a lot of folks are in that range when it comes to the retirement savings. So this, I think, may be a really good point for you folks. Hey, Dennis, welcome. Thanks for coming to the training. Okay, so I want you to consider a situation where an individual takes a qualified plan distribution of $100 and assume that they're in this range, okay? So not only will you pay income tax on the full $100, but because that distribution, because it's come from a qualified plan is something like a 401k, IRA, but because this distribution is part of one's provisional income, it could trigger or actually bump you up, and the amount of the amount of tax you pay on your Social Security benefit. So really, it could really mess with you if you're in this middle range here. So it's really important if you're in this middle range that I'm showing you here to get some help or just to really become very educated yourself. But I would recommend just getting some of the help you need with somebody that knows what they're talking about, okay? Okay. So to mitigate, we want to mitigate this. That's our word of the day, okay? Mitigate taxes. So we're going to mitigate this tax torpedo. One could take advantage of a planning strategy referred to as a reverse tax torpedo. Okay, so for those of you that don't have pen and paper, I should have told you to get it out, but now it's time to get it out because now I'm going to give you some really good stuff on how to mitigate some of this stuff, okay? So this is the reverse tax torpedo. So how it works is the retiree will delay claiming his or her Social Security benefit until all other taxable income has been exhausted. When Social Security does begin, total provisional income ideally will then be below the thresholds for taxation. And these benefits may be received tax-free. So you want to be really smart with this. You may not want to you may not want to get rid of all other taxable income, but if you're still working, things like that, that could come into play here when it comes to the strategy. Okay, so when Social Security does begin, ideally, you'll be below the thresholds for taxation. We want you to get this benefit tax-free. So that's one way to do it. And then now here are some other planning strategies to mitigate the impact of the taxation of Social Security benefits. These ones are very good, can be a little tricky, but these are what as a financial planner, when I'm working with folks, these are the kind of the lists I'm going to go through to see what makes the most sense as we're making this transition into taking Social Security and mitigating taxes as much as possible. Okay, so here's one of the first things I look at. Staggering withdrawals from tax-deferred accounts so that you exceed the tax threshold on Social Security benefits only once every 2 years. So what does that mean? We stagger withdrawals where we take them 1 year and then the next year we don't, right? So make sure we take out enough that you have to cover yourself, and once we do some planning, some cash flow planning on what your income needs to be, and we're going to do that every other year so that 1 year we pay, the next year we don't, okay? That's one of my favorite ones to do. Takes some time, effort, energy every year. That's okay. But if you do it right, it's not that complicated, but it's definitely something that I think is important. Number 2, timing the sale of stocks and other appreciated property for years when you're already subject to tax and Social Security payments, or for when you're well below the threshold. So either one of those. If you have some old stocks, like if you bought single stocks 20 or 30 years ago and you haven't sold any of them, you have all kinds of capital gains built into that. That you haven't paid on. timing the sale of those things or any other appreciated property for those years when you're already subject to it, I think that's a smart strategy as well. Something really to consider. Okay. For those of you that jumped on the Roth IRA board once it came out, I think it was 1998 when those were first started, or have been doing conversions or late contributions, but timing the tax-free withdrawals from Roth IRAs, because these distributions are tax-free and they do not contribute to provisional income. Really, really important. Tax diversification is so important. You know, I'm a big fan of doing some Roth conversions early before we take Social Security so that we can have some of these options to do these advanced planning strategies. So really important there. Another thing you want to look at is being careful when converting these traditional IRAs to Roth IRAs, as this increases, you know, the client's income or your income for the year. So ideally, these conversions should be done before Social Security payments begin. So if you haven't taken Social Security yet, and you're looking at, you might be high on the end when it comes to your provisional income, definitely looking at timing your Roth conversions, which I think can be a really good idea, but you want to time them properly so that you do them before hopefully Social Security begins. Before your 70 and a half, before RMDs begin is another good idea, but before Social Security is another planning step, okay? Eliminating the interest and dividends that are included in the provisional income formula. So if you don't need income currently, consider tax deferred income by purchasing an annuity. So you folks know here, I'm not, you know, annuities have their place, okay? I'm not 100% against annuities, but they have their place. And I think too many folks just put all their money in because they're scared and they think they're gonna run out of money because they don't really understand how to manage a portfolio properly. And so they put too much money in an annuity. But this is a case where you might wanna consider you know, getting some tax deferred income by purchasing an annuity and putting some money in there to help you avoid some of these taxes. So again, advanced planning strategy, but something to consider. Here's another thing. Maybe you want to work less. Maybe you want to go part-time, especially if you're near that income threshold. So as I'm working with clients and we're looking at how much they're earning, and if they're considering lowering their amount of hours worked, we definitely look at this. You know, we're going to look at this and we're going to look at if we took Social Security, especially if it's early, and you may have to pay some taxes on it, you know, where do we want to keep your income threshold depending on your age, right? So really, really important. Hey, Kim, welcome. Hello there. Thanks for coming to training. Okay, and then, oh, Brian. Brian came in late. He's discussing investments with his wife. Brian, part of this training is for you. You had put a comment in there and had a lower provisional income. That's what we're talking about today, right? So make sure you please go back and review this. There's some good things in here for you to consider that you may not have thought of. And then I think finally the delay of taking Social Security and instead drawing down on other retirement funds. I've talked about this in here before. In almost all cases, really, if you look at the actual, you know, there's a bunch of people, like I mentioned, they're the nerds, right, of the retirement planning world. They're the PhDs that do all this research. But if you look at most of the studies, or if you look at all the studies, almost all the time, it actually makes more sense to draw down some money from some tax-deferred retirement funds, so like 401ks or IRAs, because one, it can help you with lowering your provisional income later, but then also will reduce your required minimum distributions after age 70 and a half, which will be part of your provisional income. So if you hit 70 and a half and then you have these big required minimum distributions that you have to take, that can impact you tax-wise big time later. So you really want to look into that as you're doing this whole strategy. So if you're in your early 60s, even mid 60s, this is the time to really be planning and putting this strategy in place and these strategies in place that I talked about today, because you want to do them before you take Social Security and then also planning for 70 and a half, but then making sure that you have enough assets to cover you, that are liquid versus putting too much in an annuity that you can't tap, once you do annuitize. So it's kind of like an orchestra or a symphony where you have to get all these pieces moving together. It's not just one move, it's a combination of moves that will really help you get the overall best benefit from paying the less taxes, getting the most from your retirement funds, and really at the end of the day, keeping the most money. That's the most important thing for me, is that I want you to have the most money that you keep and use that's after tax that you can actually use for your lifestyle in retirement, okay? And one more thing is minimizing expenses, right? So if you pay off your mortgage before retirement, you're gonna be in a better position to live off an income below the threshold. I mean, that's pretty simple. More and more I'm seeing, especially in California, high cost of living states, mortgages are not paid off in retirement. And I don't know if it's always a requirement. It just, again, it's a balance. I've seen plenty of folks that have a pretty modest living need when it comes to their income need, and they keep paying their mortgage since they're paying at maybe a 2, 3, or 4% rate, and then they can keep their money invested and liquid, and they can have that to use in retirement to do other things, especially if you don't have heirs, or anybody that you're going to be giving your investments to or your assets to. Having a mortgage, if it's a very low interest rate, may make sense. But in this case, if you're close to the threshold, paying it off could make sense as well, okay? These are all case by case. These are all, everybody's in a different situation. We all have different income needs, different spending needs, and different assets saved. So these strategies will apply differently to each person. But I wanted to give you a good list of ways to really help you out to lower this provisional income. Okay, so that's what I have for you today. I try to make these trainings just really to the point, not too long. I could go for 5, 6, or 7 hours sometimes if I really want to get deep into these subjects. But if you build up your knowledge, kind of one piece at a time, it's going to stick with you better as well, and for the longer term. If you would like additional assistance with your retirement planning, reducing taxes, or maximizing your Social Security, you're always welcome to schedule a complimentary retirement strategy call with me. I take these calls personally, and we speak one-on-one, and hopefully, some folks post in the group. I try to give the most value I can, not scary, but I really want to help you guys out that are in this group that are really wanting to get your retirement right, because too many people just don't care and don't take enough time, and then it becomes a bigger burden later, okay? I want to get the stuff done for you early. If you do want help, this is what we're going to cover on our call. We're going to talk about what you're doing right, what you're doing better. Are there any big retirement planning items you're missing? And almost every time we find something. And then by the time we're done with our call, which is usually about 45 minutes, you're going to have a high-level step-by-step game plan that's unique to you on what the major financial items you need to address before retirement or in retirement are, okay? I try to deliver a ton of value for you. And if it's something that you want help with, then definitely we can talk about working together. And if not, that's okay too, not a problem. But I love to speak with you folks. I love to connect. And I want to give you the best value I can for being part of this group. Thank you so much. Okay, if you do want to schedule a call, all you have to do is go right here, kisplanning.com/apply. KIS, like keep it simple, planning.com/apply. That is where, I love Jim's comment, you should get CPE credit. Yeah, you probably should with this. But kisplanning.com/apply. You'll be able to schedule a time that works for you best. I'll do my best to help you out in that time. These slots are limited, but I do release new ones, every few days or so, okay? So if you're interested, you don't have time now, that's okay. But let's get a call booked. Let's meet each other. Let's chat. And if you have some situations that need additional help and assistance, I'm happy to help you out. I would love to be your guide on this journey, okay? So that's pretty much what I have for you today. Let's go and see if there's any questions. If you guys have questions, let's drop in the comments. I'm going to stay on for a few minutes here and answer your questions. So if you have anything, Craig, you're welcome, of course. Again, I know this is going to get a little technical, Jim. I know that's why you should get some continuing education credits for this. I definitely agree. But I want to give you guys some things beyond the basics a little bit. I'm going to bounce back and forth with that, but I do want to give you some good strategies. So any questions, please drop them in the comments. I'll stay on for a few minutes here. I see we have about 12 people still on here. Any questions, guys? Any questions on Social Security, on anything that we talked about today? If not, that's totally okay. So if you watch this training later because it's Sunday, you're out doing some fun things, then just leave a comment down below and I check them, and I'll do my best to go in there and answer them. If it's something that's too specific that I think I need more information from you personally, then I'll probably recommend we either get on a private message or we just set up a call, because there's only so much you can really do, and I don't want you exposing your whole situation to the group. But if you have general questions on anything, I'm here to help. Once again, my name is Jason J. Hamilton. I am the founder and CEO of Keep It Simple Financial Planning and the admin of this group. If you need anything, I'm here. I want to help you. I want to be your retirement coach. Thank you so much for joining us today, and have a great weekend. And throughout the week, I'm sure we'll be chatting and interacting. But I appreciate you guys. And if you have, I should say one more thing. If you have friends or family members that are in retirement range that want to learn more, please invite them. You're allowed to invite them to the group. That's not a problem. But please notify them that you did invite them so that they know, because what will happen is that they'll just be automatically added. They won't necessarily get a notification. Facebook is weird like that. But let them know. You're welcome to invite anybody, friends and family, that you would like to the group that you feel would benefit from these trainings or from the interaction or from learning, okay? So that's all I have for you guys today. Have a great day. Appreciate you so much, and we'll talk soon. All right, bye-bye.